Okay, we're going to go ahead and get started. So my name is Jennifer Young, and I'm with University Credit Union, obviously. If I wasn't, I was in the wrong place. And Marky Johnson is joining me today.
Hello.
And Marky is one of our mortgage consultants, and she's also one of our reverse mortgage specialists. And today our conversation is going to be focused on the reverse mortgages. And we're going to go over a couple of myths and misunderstandings, misconceptions, and try and give you as much information as we possibly can. But to make this even more successful, we're going to rely heavily on your questions and you having a conversation with us as well. So you know where the question line is. If you can type those questions in, we'll go ahead and watch those and stop periodically and answer some questions. But we're going to dive right in and get started. And Marky is going to start us off with common myths and misconceptions.
Yeah, so there are a lot of common myths and misconceptions out there about reverse mortgages. They really kind of have a bad rap, so we just kind of want to go over them and debunk a lot of that. The first one, a reverse mortgage sells the home to the bank. That is false. The homeowner keeps the title to the home just like they would with any other type of mortgage. The next, I think, most common myth is that heirs won't inherit anything. They think, if I take out a reverse mortgage, it leaves nothing for my heirs, and that is also false. So the estate inherits the home as usual, but there is a lien on title for the amount of the reverse mortgage plus any accrued interest and the mortgage insurance premium. So just like any other mortgage, you have a lien for the loan amount, and that'll be paid, and anything that's left would go back to the estate. So for example, if someone takes out a reverse mortgage and owes $50,000 after 5 years, then the homeowner passes away and the estate sells the house for $250,000. The lender would be paid the $50,000 that they're owed, and the estate would inherit the remaining $200,000. Next one, the homeowner could get forced out of the home. That is false. As long as one of the primary borrowers lives there more than half of the year, they cannot be forced out of the home or foreclosed on. Someone can outlive a reverse mortgage. That is also false. The reverse mortgage becomes due when all homeowners have moved out of the property for 12 consecutive months or passed away. And we have just a couple more. The homeowner pays income taxes on a reverse mortgage funds that they get from the reverse mortgage. So that's also false. The proceeds from the reverse mortgage are not taxed as income, but we always recommend consulting with the tax advisor for more information on that. A lot of people think that their Social Security and Medicare will be affected. Also false. Money from a reverse mortgage is not considered income and doesn't lower your Social Security or Medicare benefits. You'll want to contact your local program office or your attorney to determine how or if the proceeds might affect your specific situation, but overall it shouldn't be affected at all. And the last one is that there are large out-of-pocket expenses. That's also false. Typically, the majority of the lender closing costs and fees can be financed into the reverse mortgage.
I'm almost surprised by how many questions there are on reverse mortgages, just because they've been around for quite some time. They've been around since like the late 1990s. And so there are a lot of concerns and there are a lot of questions out there, but the most important thing that I can say is that we really encourage you to reach out to us, because we want it. They are definitely not for everyone, but they are definitely a really good tool for those that qualify and those that need this help.
Yeah.
This can really make the difference between. So I'm going to cover what is a reverse mortgage. So just like a normal mortgage, you have a lien that secures the property. But unlike your traditional mortgage, this mortgage starts out with a lower balance and accrues a balance over time. A regular mortgage might start off, if you start off and you see our diagram, you start off with $250,000 and over time you pay it down to a zero balance. A reverse mortgage starts the opposite. It might start at a zero balance, or if you choose to take a big disbursement, it might start at a smaller balance, and then it accrues over time to a larger balance. You're living off of the equity of your home, and that's what a reverse mortgage does. So it enables you to withdraw a portion of your home's equity and use it any way you choose. Now we're going to emphasize that. You can use it any way you like, and you will not make monthly payments on your mortgage. The only payments that you'll be required to pay are your property taxes, your homeowner's insurance, and if you live in a homeowners association where there are HOA dues. And you can stay in that home regardless of how long. If you live another 35 years or another 50 years, you can stay in that home until you pass. At that time, whoever is the inheritor of that home or your estate would be required to relieve whatever the lien is on the property. Now, there is a question on that. Some people have asked us, what happens if I die and I owe more than what the home is worth? Then fortunately for your inheritors, they're not handed a bill. It's not something that if the home is worth $300,000 and the debt is $350,000, they don't get a $50,000 bill. It would just go away. That's why these loans are insured by FHA, and that allows you to stay for as long as you're alive, regardless of what happens. So if there's equity, they get it. And if there's no equity, they don't get a bill, which is a really nice thing.
Yeah.
So hopefully that helps explain what a reverse does.
So now we'll go over who qualifies. So the homeowner or homeowners must be 62 years of age or older and own or be purchasing a home that is considered their primary residence. Reverse mortgages aren't just for people that already own a home, and they can be used to purchase a home. The home must meet standard FHA appraisal guidelines for the property type, value, and condition because they are insured by FHA. And then since the borrower does not make a monthly payment, there's only normal income and credit review to ensure the reverse mortgage is the best solution. So when we're doing the process and going through everything, your credit isn't looked at as heavily as it is if you were doing a normal mortgage. That's not really what it's based off of. With reverse mortgages, the main things that are looked at are the age and how much equity there is in the home.
Okay, and is it safe? A reverse mortgage is like any other mortgage. There's a lien placed on your property. You retain ownership. You can refinance the home or sell it at any time. Just because there's a reverse mortgage on it, it doesn't prevent you from selling or even refinancing and paying off that reverse mortgage. You can do any of that at any time. The only restriction that is asked is that you do not do a home equity line behind a reverse mortgage. So if you have a reverse mortgage on your property, that will be the last lien. You wouldn't have any subsequent liens. Hopefully that makes sense. Is it safe? Paying off a traditional mortgage with a reverse mortgage secures the home and can help mitigate the risk of foreclosure that may occur on a traditional mortgage due to an inability to make monthly mortgage payments. This is the biggest plus that I can see about reverse mortgages, is once you do a reverse mortgage, you are not required to make mortgage payments. The only obligation, and I said this earlier, but again, the only obligation is to make sure that your taxes and insurance and homeowners association dues are paid. So no longer do you have to worry. And we have actually helped many people in this situation where they have been facing not being able to afford their regular mortgage and have been able to do a reverse mortgage and stay the rest of their life in their home without having to worry about paying mortgage payments. What a great gift that is.
Without having to worry about being foreclosed on or moved out. It can really be great. So we'll go through quite a few benefits that there are. We've already touched on a lot of these, but we'll just kind of reiterate if we've already touched on it. So again, the homeowner can stay in their home without making any future mortgage payments for the rest of their life. And like Jennifer said, that's the biggest benefit. Unlike a traditional mortgage, your credit score does not qualify you for the mortgage loan. So if you're worried, if your credit's not the absolute greatest, you don't need to worry. It's still an option for you. Could help prevent a future foreclosure, like we mentioned, access to needed funds. So if money is tight, and there's a couple different ways that you can have it dispersed. You can take monthly disbursements, you can take lump sum. There's different options there. And we'll go through a couple of examples that go over that as well. Almost all properties qualify. So if you have a townhome or you have a condo, just because it's not a single family home doesn't mean you wouldn't be able to. If it's your primary residence, almost all properties qualify. The future value of the home is inconsequential. It's based off of what the value is now. And like I mentioned before, it can be used to refinance or to purchase, either one.
I think this is a great thing to remind them about, that the future value of the home is inconsequential. I love that, because regardless if the values go up or if the values go down, we're at a really strong value market right now. And if the market continues to increase, good for you. And if it doesn't, that's okay too, because once you're secured in a reverse mortgage, that doesn't have a play on it anymore.
It's insured and you don't have to worry.
Yeah, that's a great thing. So how can I use my funds? This is a great option too. We don't monitor, and the reverse mortgage, the companies that insure these things, don't monitor what you use your funds for. We are really going to counsel with you and hopefully help you to make sure that you're using these funds wisely, and that we're not putting you in a situation where you're going to get down the road and need more funds or be in financial trouble. We really try and counsel with our members and sit down and do what's in their best interest and help you kind of plan for the future and make sure that you're putting yourself in a great position. But we do not monitor what you use those funds for, so that's up to you. And again, just a reminder, the things like taxes, insurance, and your HOA have to be paid. But these funds are great too. The reverse mortgage funds are great too for things, repairs on the homes. So many people can't afford to do repairs on their properties, even though they've worked so hard all these years and they paid them off, and then they can't afford to maintain them because the repairs are so expensive. And this is a really great option for you.
Definitely. So now we'll go through a couple of examples of people that we have helped here at the credit union and the situations that we've been able to help people a lot. I think it's good to be able to relate and give you some real life examples. So we have Jim, who's 74, and Barb, who is 72. They were looking at mortgage options. They had a first mortgage with a balance of $54,000. It was on a 15-year loan. Their payment every month with their taxes and insurance was $1,370. They recently had to get their roof replaced and get a new HVAC system, so they took out a home equity line of credit for $20,000. Their other debts include an auto loan and a credit card, and their total monthly debts you can see are as follows. So they have their mortgage that we talked about. The home equity line is $200 a month, auto loan $400 a month, credit card payments of $300 per month. So their total monthly expenses just for loans was $2,270 per month. Jim and Barb have multiple sources of income. Both of them collect their Social Security. So Jim's is $1,911 per month and Barb's is $632. Both of them obtain pensions while working. Jim receives $432 and Barb receives $378. Barb also worked as a crosswalk guard for the local school district and received $400 a month during the school year. So their total monthly income was $3,753 most months. So at first glance, it looks like Jim and Barb have $1,500 a month for other expenses and seem to be comfortable. But once we add their total expenditures, we see a different scenario. So you add in auto insurance and food, inside and outside of the home, their gas for their cars, their utilities, and their charitable contributions. So they have a total of $1,325 in other expenses. So they're bringing in $3,700 a month and they're spending almost $3,600 a month. So really they're left with nothing and they're living, paycheck to paycheck, so to say. So they came to see us about completing a 30-year refinance to lower their monthly mortgage payment. Once the numbers were completed, we showed them we could combine all their debt and their new monthly payment would be $835 a month. Combining that with their current monthly obligation, their new out-of-pocket would be $2,160. Jim expressed that while Barb loves the kids she sees every morning as a crossing guard, it's beginning to get difficult. Long-term, their monthly income would be $3,350, while their debts would be $2,160. So it would leave them a little more than $1,000 per month. So that seems like a good option, and it could be a good option, but we thought
it was an improvement over the first scenario.
A huge improvement, but that's where we thought that we could do better and where reverse mortgage is a great option for them. So we combine all of their debt into a reverse mortgage. So since they have $3,353 of monthly income, they opted not to receive a monthly stipend. However, funds are available if they wanted to draw them out at any time. After their essentials, the members have over $2,000 a month of income. So their monthly finances were no longer cumbersome. They're able to relax and enjoy their well-deserved retirement and have money to actually do things.
Yeah. Improves the quality of life.
Yeah, and then like we said, all they have to pay are their taxes and insurance every month.
Which is a great scenario. So the next scenario is just a little bit of a twist on that. So Lee and Mary, 83 and 79, currently live in a home in Sandy, and they're concerned about the amount of steps that they have to traverse daily. Their home is multi-level, and so they came in and discussed the idea of selling their home and buying a Rambler in Sugar House. Both of their children lived in Sugar House, and they really wanted to be closer to their grandchildren. And so this was an option that they were looking at. And so their home in Sandy is currently paid in full, and they were selling the home for $385,000. The home that they wanted to purchase in Sugar House was $450,000. After they pay their realtor to sell their home, their net profit on their home in Sandy was $360,000. They would need to get a mortgage of $90,000 to move into the home that they wanted to purchase. They have total monthly income of $2,800, and they do not have any other debt. So this seemed like a really good doable option. At Mary's request, we discussed a 10-year mortgage for them to purchase this new home. The new taxes and insurance on the property they selected are $248 a month. A 10-year loan payment would be $1,180. After observing the stunned look on Mary's face, we asked what a payment she was hoping for. She said that she didn't want to pay more than $500 a month. When we calculated the payment on a 30-year loan, the payment would be $844. So $844 on a 30-year, that was the longest we could run it out, the amortization. And Mary was visibly disappointed. She turned to her husband and said, I don't know if we're going to be able to afford this. She was really, really discouraged, and she was upset not only for her health, but the finances. And that was still the most important concern. She was willing to stay where she was and do the stairs because the finances were still the most important. And so consequently, one of our mortgage specialists suggested considering a reverse mortgage. They were very opposed at first. They were not interested at all. And so the specialist went through and said the reverse mortgage would allow them to purchase the home, move in, and only pay the $248 a month for taxes and insurance. They would be able to take that small additional balance and put it onto a reverse mortgage and never make a payment again. So after dispelling all of the rumors and listening to their concerns, Lee and Mary went back to discuss with their children, and they decided that moving in and enjoying the time closer to their grandchildren was the most important thing. They moved into the new home without a monthly mortgage payment and an immense amount of stairs from their old home, and they are able to enjoy their later years with their children and grandchildren nearby. This to them was life-changing.
Yeah.
They had the opportunity to really change and impact the quality of life.
Definitely. So as far as the process goes, a lot of people don't know what the process looks like. So if this is something that you're interested in, you can contact one of us, and we'll provide contact information at the end of this for our 3 reverse mortgage specialists. But we have you fill out this analysis request form. It is not an actual loan application. It does not require your social security number. We do not pull credit, but we do get your name, your date of birth, some information about the home. We send this in, and then we're sent back options of what we could potentially do for you, an estimate of the loan amount that we'll be able to do and the different disbursement options and things like that. So this is really the first step that you'll want to complete if it's something that you're interested in. And then we'll be able to go over the options for you once we get those back and go over if it is a good option or not. And then at that point, if it's something that you want to move forward with, that's when we would go through a formal loan application and gather other documentation. So it really is very simple if it's something that you're wanting to explore the option of.
Okay, there are a couple of questions that have come in. We've covered a lot of information, and so if you do have questions, holler and let us know, but I'm going to have Marky cover the first question.
Is there a way to get copies of these examples and other information or an audio to listen to again later? So these are
great.
Yeah,
That's a really
these are
great question.
actually posted on our YouTube channel, so you can go back and watch or listen to the webinar again, and all of the examples will be there as well.
In addition to that, after we finish with this, we record these webinars for you. So after we finish, we'll send you an email that says, thank you for attending, and here's a copy of the link so that you'll have a copy of this webinar that you can go back and refer to. So that was a really good question. Thank you. And that helped us remember to remind you to tell you. So
Yes.
I always forget that
yes,
part.
Definitely. So. Another question, do both of us have to be 62?
If you're on the loan, yes. It requires that you are 62 or older. The home equity conversion mortgages, the HECM as they call them, the reverse mortgages, do not allow you on it if you're below 62.
And I just want to add to that, there are a lot of, so-called horror stories with reverse mortgages. And one thing that's important, I think, is for both homeowners to be 62 and be on the mortgage, because let's say one of you is over 62, one of you is not. You do the reverse mortgage in the one's name and they pass away, then the other person, to stay in the home would need to take out a mortgage if there's a lien, and if they don't qualify, it could just create problems. So the best advice that we give people is, it is best to have both people be 62 or older if possible.
Yep. You have to be 62 to be on the mortgage.
Yeah, I just think it's a good idea for, everyone, because if you're not, it could create problems if one passed away and the other, you can't take out a new reverse mortgage if you're not there yet.
We actually have had a situation where we've had two borrowers come in. One was 62, one was not, quite a bit younger. And they did a warranty deed after we closed. They did a warranty deed over into both of their names. Unfortunately, a couple of years later, he passed away and she was left in. She wasn't old enough to qualify to maintain the reverse mortgage and had to go ahead and
sell the home.
She didn't have to sell, she just had to refinance and put a new mortgage on it.
Yeah, but there's
the reverse mortgage she didn't qualify for it.
Yeah, so there's just the concern if for some reason there were qualifying problems with a normal mortgage, I think is what.
There are scenarios, but that's why you want to call us and talk to us so that we can work through scenarios with you and see what is going to work in your best interest.
So the next one, what are the LTV requirements? So again, that's where we would fill out this analysis request form. It really is based off of age. The older you are, the more equity you'll have access to. So when we fill out this form and send it in for them to analyze, they'll send back and let us know what loan to value we would potentially be able to do for you. So there's not a straight answer on that, unfortunately.
It's kind of common sense. These reverse mortgages give you the option of living off your equity for the rest of your life. And so it's based on longevity. So the older you are, the shorter longevity you have, and the more access to equity. So that's kind of the common sense. The older you are, the more that you have access to. The younger you are, the longer you're going to live, and the less that they're going to give you up front, because over time that's going to accrue a balance. And so that's just kind of the common sense of a reverse mortgage.
Yeah.
So Marquis, I'm gonna.
One more.
Okay, we've got one more question. Kim, let's address.
So one more is, I've heard that the closing costs are very costly, more than usual. Is that true?
Closing costs on reverse mortgages can be pricey, but again, it's kind of risk-based. So they are a higher risk because FHA has insured them. They're betting on that you're gonna live for a certain amount of time, and so they are a higher risk. Yes, those fees are a little bit higher than a standard, but not excessive. I wouldn't call them excessive, especially for what they're offering for the loan, that you're not making any payments on it. You're not doing anything on the loan for the rest of your life.
Yeah, exactly.
So based on that. There's a question that came up a little bit ago, and I wanted to have Marquis help address this. So Marquis, I'm a prospective borrower for a reverse mortgage, and my kids have said, do not do this. Like, Mom, this is a really bad idea. Do not do this. Is there anything to help my kids? Like, what can I tell my kids? Is there anything that I can help my kids to understand about them?
These loans actually require you to go through a formal counseling program with a counselor that does not work for the credit union. I believe they're HUD counselors.
They're HUD certified.
So, and you can bring your children.
You're actually asked to. You have to bring someone.
You have to bring somebody, yeah. And most older people, bring a child or children, and they can address any concerns that you have. And the biggest reason is because they want to make sure this is a good option for you, that you fully understand what you're getting into. And if you're not able to fully understand, that someone that is caring for you or helping care for you can understand and help you understand. So That is required. It's not optional, and we do require a certification showing that you've completed that.
Which is a really nice thing. They want to make sure
Yeah.
these are not loans that are meant to take advantage of seniors. These loans were implemented specifically to be a help and a benefit for seniors, not to take advantage.
Yes.
So we do not want to see you get into something that financially is a bad idea. And quite honestly, if it was a bad idea, the credit union would step in and say, you know what, this is not really looking like it's your best option. Let's go ahead and help you out.
Exactly. And that's what we'll do when we meet with you too. We'll go over your options. If we think it is beneficial, we will let you know. But if we think that there's a different option that will be better, that isn't reverse mortgage, we'll also let you know that we want truly, you know, what's best for you. And we always have that in mind. And I think that's really important because not a lot of places, you know, have that.
So we have another question that has come in, a couple of questions. These are good questions, guys.
They're great. Is it possible to just pull out funds as needed, or do you need to do a monthly payout? You can pull out funds just as needed, so you can choose. There's a few different ways that you can do it. You do not have to choose a monthly payout. You can just have access to it and pull when you need it. You can also do a monthly payout if that's what you want, or you can do just a lump sum as well, but you don't have to do a monthly payout.
There's they usually send us 3 scenarios or sometimes 4 scenarios that say like based on a monthly payout, based on a one-time lump sum, and then based on a line of credit that's similar to like a home equity line of credit where you can take different amounts as needed. And all of those are options. That's a really good question too. Good job. Any other questions?
I think we've covered those all.
Okay, the most important thing that you need to know is where do you get any more answers that might come up, and that is reaching out to us. So the 801-481-8840 that you see on your screen is a number directly to the mortgage specialist. And all you need to say is, I need to talk to a reverse mortgage specialist, and you'll get one of these 3. Marquee Covers are Bountiful, and you know, I say covers, and that's just where her home office is. She actually goes wherever our members need, and that's with all of our mortgage consultants. But she's located in Bountiful, and Brickyard is Taylor Riley, and then Dawn Taylor is in our Draper branch. But we are welcome to meet you anywhere you would like, and I will tell you in some circumstances, if you can't come to us, we would be happy to come to you. Just let us know. When we do that, we would typically send 2 of them out to answer questions and go over the information. But we really look forward to helping you through this. Reverse mortgages is just one more of the options that we offer here at the credit union, and we love doing mortgages. You hear us here every month, and we talk about different topics. But if you do have questions, reach out. That 801-481-8840. And I think we have covered all of them. We covered all of them, James?
Yes.
I think so.
Okay. You guys, thank you so much for joining us, and have a great afternoon.